Let me ask you something. If your bank fails tomorrow, would your paycheck still go through? Would your debit card stop working? Would you actually lose your savings? Or do you believe is there a system already designed for this exact scenario? Most people don't know actually what happens when US banks collapse. They imagine chaos, but the reality is more structured, more boring than headlines suggest. Today I am going to walk you through exactly what's happened inside the US banking system, step by step. What gets protected, what doesn't, what rational people actually do in this situation. Let's start with banks collapse really means. So we need to define something very clearly. When people say banks collapse, they only imagine one thing. Total finance chaos, like 1930 panic. ATM shutdowns, line outside the branches, saving goes overnight. But in modern America, bank collapse means something very specific. It means regulators step in because banks fail to meet withdrawal demand. It does not automatically mean the entire US banking system failed and your insurance money disappears. Now, here the key question. Why does this happen in first place? To understand that, you need to understand how actually bank operates. And once you see how the banks operates, you will realize something very important. Most collapses are not what people think they really are. Let's break it down. Here's the what most people don't realize. When you deposit money into your bank, the bank just not store all of it in a wallet. If you deposit 1,000 into a bank, that exact 1,000 is not sitting in a drawer waiting for you. Bank operates something called fractional reserve banking. It means bank keep liquidity buffer and it lend the rest. That's how bank loans, business loans, credit cards, mortgages happen. So finally, your deposit become part of the lending engine. Now here's where things get interesting. This system works perfectly fine as long as not everyone asks their money back at the same time. But if thousands of depositors withdraw their money suddenly, that creates pressure. That pressure not because of bank is bankrupt, but because of cash moves slower than panic. And this is where most headlines confuse the people. A bank can have valuable assets like investments, bonds, loans, but still face short-term stress if too many withdrawals hit at once. That's called liquidity crisis. And that is very different from true insolvency. We will talk about difference next because that's where things really matter. So now let's answer the uncomfortable question. When a bank collapses, who actually loses the money? Because someone does. First, shareholders. If you own stock in the bank, that investment can go to zero. That is risk capital. Second, executives. They lost jobs, reputation, often compensation. Third, uninsured depositors. If someone has tens of thousands of millions packed in one institution above the insurance limit, they can face exposure. But here is what important. Retail depositors within FDIC limits historically has been protected. But that doesn't mean zero stress. Also, it does not mean temporary inconsistencies won't happen. It means the system is designed for protect everyday depositors first. Now this brings us to something more serious, systematic risks. You hear that term a lot, but what does it actually mean? Systematic risk does not mean one bank failed. Systematic risk means the failure spreads, interbank lending freeze, payment systems slow, and competition collapse everywhere. But here are the key distinctions. A single regional bank falling, usually contained, multiple large banks falling simultaneously. That's when central bank step in aggressively with liquidity facilities, emergency lending, and stabilization measures. Because banking run on confidence, and when confidence cracks, policy responds more quickly. So understand that difference is what separates headline from mechanism. So the real question becomes what rational people actually do instead of what panic suggests and what headline imply. What actually makes sense? First, understand your coverage. Most people panic without even realizing how their account are structured. So to understand that, check how much you have per bank, how your account are titled, whether you are within FDI insurance limit. If you understand the limit, you operate within the system's protection design. Second, if you hold very large cash balances, spread them across insured institutions, not because of collapse is guaranteed, but because of diversification reduce concentration risk. That is basic risk management. Third, avoid emotional withdrawal. History shows something important. Bank runs are driven by more fear than insolvency. When depositors withdraw purely from panic, they accelerate instability. Fourth one is know the difference between cash deposit and investment. If your money in a brokerage account, that is different risk framework entirely, confusing those who create unnecessary anxiety. And finally, stay data focused. Watch capital ratios, earnings, annual reports, not viral tips and rumors. Financial systems are complex but not random. And when you approach them calmly, you tend to make better decisions. The goal is not predict the collapse. The goal is understand the system. That's how you stay stable even when headlines aren't. So now I end the video. See you in next week. Have you any question or lost understanding about something? Comment below.